Hey friends, Cyrus here. So a few weeks ago, back in December, Iman and I spoke at the McKinsey Early Stage Investor Conference. We had a lot of great feedback from VCs and founders. So I thought, why not upload this as a podcast episode? It was on Zoom, so apologies in advance for the audio quality. I was not expecting to upload this as a pod. It was just a Zoom recording. Hopefully in Q4 2021, Iman and I will actually be there on stage at the conference. Days of excessive Zoom will be over. So hope you're safe wherever you are. Enjoy the episode. So we'll kick off, guys. We'll keep questions for the end, please, because at the end we'll give a good 15, 20 minutes for people to sort of speak about their startups. We'll have a group sort of discussion. So please try and, if you've got any questions, we'll try and get to maybe 2 or 3 of them at the end. Otherwise, we will be sharing our email addresses at the end. We're more than happy to jump on, let's say, a 20-minute call, 30-minute call with anyone that just wants to chat, or any potential intros if there's any way we can help. This is a long-term game and these things go a long way. So we'd love to meet as many of you as we can afterwards as well. And we'll kick off. So I think the first thing we'll go into really is more around the foundational pillars. As basic as some of these things may sound, is go-to-market strategy, which is Iman's expertise. So we'll let you dive in, Iman, and after this we go on to the more probably juicy topics or juicy to you guys. Everything here is juicy to me, but juicy to you guys, which is VC fundraising and product management and all of these things. But these things are key. So I'll pass it over to Iman.
Cheers, Cyrus. So essentially all we're trying to say here is that this is the approach we think about when we look at startups, particularly in the pre-seed and seed phase, but this applies all the way through to IPO or SPAC in many scenarios. We're looking for 2 things, and we're looking for an ambition and actions to back it up. And implicit within that is kind of my background of strategy. What is the strategy the business is targeting? The key to your ambition is fundamentally around how you articulate, how you communicate the value, the sort of vision, mission, and values that your business is bringing to society, to the community. But what's the underlying purpose? What is the value beyond the financial that your business has? Now, I'm lucky that a lot of the companies that I work with in the energy space tend to have quite a strong purpose because they're solving the climate crisis. I know Nicolas, who's on the call right now, you've also got a space in the energy space. So the purpose that sits behind your business is pretty important. The way in which you communicate it and your leadership as an individual, particularly if you're a founder, is also something that we look at. I've written a detailed guide on our website for founders looking to develop their business. And this guide essentially highlights 2 examples of Elon Musk and Jeff Bezos. And these guys aren't great orators. They don't speak well, but fundamentally they're very to the point, they're concise, and they can articulate the purpose of their business. So we're looking for founders like that. And then on the action side is essentially just your value proposition, the cold, hard facts of your business. How do they stack up? So we're looking for a real market problem. We're looking for a solution that's not just a product, but that has a product that is valuable. We're looking for a go-to-market plan that includes your customers, your channels, your timeline for going to market. And then we're also looking for the other stuff, like what's the size of what's the target addressable market? What's the market size? What are the financials of the business? Although this is not as important if you're a pre-seed or seed startup. What does the future of your financials look like is very important. And then who's the team? Like, we know the founder from their ability to lead the business and set it up, but who else is on the team and what do they bring that is core to the value proposition of the business?
Sorry, man. I was just going to jump in and very quickly say this might seem like very extremely basic and sort of boring stuff to most people, but time and time again, especially if you're going to VCs or let's say a high-level deck of what you guys are doing, one problem that we see among founders who either struggle to get fundraising or the business doesn't gain traction once they raise funds is the lack of clarity around these basic principles that Iman's outlined here. And as basic as they sound, these are the things that VCs usually say, tell me in exactly one line in less than sort of 15 seconds exactly what you do. And these things bring clarity to what you are actually doing. So, a great example is Netflix, Reed Hastings and Patty McCord, who built the infamous it got a little bit of a bad rep, but I think it's fantastic. The Netflix culture deck back in the early noughties, which was very clear and around, these are our expectations. These are the people we hire. If you're not an A player, you get a severance package, for example. They had their vision, mission, principles, I think in the original deck as well, actually. And this really can be just a one pager from you. It doesn't need to be in depth. But you'll see as we go on to product and then fundraising, the common thing, the recurring theme here that we keep going back to is, what is the actual problem we're trying to solve? Because people build the product first without usually getting to grips with what are we trying to solve. So first, be very clear with what the problem is. And then as a result of that, you can come out with the 1 line or 2 line mission, vision, and then your principles, or as some call it, the values. And it could be, let's say, 5 values or 6 values, but they shouldn't be very vague, like, we will push through regardless of what happens. I think the best way for you guys to get an idea is you can Google some. There are some great examples out there of now unicorns. I mean, DoorDash and Airbnb, great examples, now gone public. You can see those guys, their early decks online, but it's very important for you as part of your go-to market to have these basic principles outlined, so that when you are going off track on a daily basis, and everyone goes off track, every decision you make is this action we're taking, does it align with the vision, mission, principles? No? Okay, let's get back to what we're doing. Let's regroup, let's focus. So it really is to keep you on track. And as humans, I think we're all fickle to an extent and get tricked by short-term rewards. And it's very important for you to just stay on track. And these things will you can print out 10 copies, stick it around the office, whatever works for you. But it's just important for you to have these in mind at all times.
Absolutely. I think Cyrus picked up on a bunch of the key questions that sit on the right-hand side of the slide there. But essentially what we're looking for from a value proposition perspective is, do you have product market fit? It's a term that is thrown around a lot in VC, but all we're looking for is fundamentally, do you have a minimum viable product up? How is that being responded to in the market? Who's buying it? Who are the customers? And how quickly are you selling to them? If you jump to the next slide, Cyrus. I'll wrap up this bit on go-to-market strategy just with 2 points. One around ensuring that you're spending as little money as possible. You're being as lean as possible with your hiring, spending, and building, especially in your first sort of 2 to 3 years. I appreciate some startups might be past that 2 to 3 year mark, but if there is anything that you can automate or outsource, we like to see it being done so. And we want to limit the focus on things that aren't your main core offering. This is startup accelerators like Y Combinator say this over and over again. And actually, if you read Paul Graham's latest piece on, he's called it the Airbnbs, which is what really drove Airbnb to success up until their IPO yesterday, was that their focus and their drive of the founders was phenomenally strong, in the sense that they didn't try to go and do 20, 30 different things. They would embrace ideas from other people. In fact, the founders would sit down with notepads and write pages and pages when they were talking to people. But it doesn't necessarily mean that you need to encase your business plan with all these different areas and go-to-market channels. All it means is have something that is a North Star, that is central to your business plan, that is central to your product, that is central to what you're selling and your product market fit, that you then pivot everything around. Simplicity is key, and focus on that simplicity is what works. This applies for your hiring, the type of people that you have. Stay lean with your people. It applies to your building. Stay lean with the tech that you're building. Don't add way too many features that are unnecessary. And of course, it applies to your scaling. So when you're looking to scale, when you're looking to spend, is that really necessary? Do you have a very strong customer demand, a strong product market fit that you're going to disrupt by moving outside of that market? I'll pause there and pass on to Cyrus.
Yeah, I think Iman summarized it very well. And going back to what we previously said, the importance of really just your North Star, which is what really, even the most seasoned of seasoned VCs who have been in the game for 30 years will say that the foundational pillar before we get to the more juicy topics are really these basic principles. And you'd be surprised sometimes people post Series A, post Series B, they forget these basic principles and, they fail to really gain further traction or they stagnate. So, we'll hop on to the next part, which is really around your product function. And what does this mean? So this entails a number of things. So when you're essentially first building out your company, up until employees 1 to 20, it's usually advised you don't need a product manager. And I agree. Once you've raised some funds and you've got 20 plus employees, you'll probably bring in a product manager or two as you scale, your product team grows. Before you're able to bring in a product manager and you're staying lean and, it's a small team, the product management function or the product function itself has to be split up amongst you, the founder, the engineers, so anyone who's technical, basically anyone and everyone who has a say in the company and who works. It could be a 4-person startup, a 2-person startup. You've got to work on product. And so the top mistakes that we see are essentially, as I've outlined here, is really spending a ton of time building the product instead of talking to users. And so people will build, especially engineers are guilty of this, and those who are more technical, they spend a ton of time worrying about automating this and scalability and fixing bugs and handling all the technical debt. And then aside from that, they also have this constant worry and anxiety of, some people have this. I'm an engineer, I'm an introvert nerd, I like to code. Especially if you're, let's say, in a B2B sales, which can be intimidating to some, going into these big corporate boardrooms and trying to pitch your product or whatever it is, gets a bit intimidating for some engineers. Can get intimidating for most people really at the early days when you've got so many things going on. And I suppose their worry is, I need a co-founder who is a slick sort of salesman, or in the case of Airbnb, for example, like a Brian Chesky. You want someone who's very good at selling the company and the product. But the thing is, especially if you're B2B SaaS, for instance, or any B2B in general, what you need to remember is these companies, these customers, they actually want to be speaking to you, the engineer who's building the product. Especially in a B2B, the sales cycle is so long. Some cases 6-9 months plus even. And so it's not a get a slick salesman in front of them and quick wham bam close the deal. It doesn't normally work that way. There's a long sales cycle. It's more of a get to know each other, and those purchasing from you, the execs or whoever makes the decision in these other corporations to purchase your product, whatever it may be, they want to build a relationship with you, the engineer, because you understand the technicalities of the products and the back end better than anyone else. So you don't need to worry about the early days bringing on a slick salesman. We'll get onto sales as well. It does lead on to other parts, as I've outlined later. But don't worry too much about fixing bugs, scalability, automating. And another thing we see, which is the sunk cost fallacy, which is the early days, essentially you're experimenting. So you're allowed to make mistakes and pivots. Something that we see very common among founders and even some companies that in the past I've sort of worked with or advised or whatnot, is they'll raise a bunch of funding, and then you'll see that something's not working, but they won't let go of it. And sort of, it's very important to be honest with yourself. As Frank Slootman says, be irrational, but cut your losses when it makes sense. And once it makes sense, cut it quickly, move on to the next thing, because I'm sure you have a ton of competitors out there, and before you know it, you'll get crushed. So, and then the other thing is, once you do gain a little bit of traction, you essentially, not gaining traction, but you may not be gaining traction, and you give up on the product or a feature too soon because you've underinvested in sales or go-to-market. And you may say, okay, well, this contradicts what you said earlier about not bringing on a slick salesperson. It doesn't mean don't bring someone on, but it means just generally, this is more so especially for those who've raised a pre-seed seed round. I think the most important thing is, if you are technical or if you're building the product, as soon as you raise some funding, you need to instantly bring in someone who can someone who's, you could call it a jack of all trades, or a Swiss Army knife as they call it, who's very good at the sales biz dev, but also at the same time can pick up product and strategy and etc. So I think these are some important points to really bring to your attention. And I say the most annoying thing, especially me and Iman being in the UK, is a lot of companies and startups, the product function is very much focused on all of this Scrum Master nonsense, which, people who come over from the US or Silicon Valley, or a lot of the unicorns, they come over, they're just shocked at the inefficiencies of the product management function within companies, whether it's an early stage or you've raised a ton of funding. The issue is, it happens in some US companies too, all around the world. People are very focused on shipping software when it comes to the product management function. And what they should actually be focused on is shipping outcomes. And people don't like to do this. Why? Because it means you have more skin in the game. People don't like to have skin in the game at all times. But I think this is what causes companies to win. And so you need to be tracking your outcomes really closely, really closely, meticulously. And what are some outcomes? So you need to take ownership of things such as contribution margin, net retention, customer acquisition cost. And then there are things such as monthly revenue and the ramping of customers and the sign-up volume, all of which you take co-ownership of with the sales team. So let's say, hypothetical example, there's 5 of you. One person is leading sales, and you're heading up products and engineering. Your job is to sit in those sales demos and pitches and presentations and customer support inquiries with the sales team. Because as the product team, your core focus really is to understand the users. And going back to how I started this slide, is the foundational pillar of any startup beyond the things that Iman outlined. The next step really is, when you're building out your product, people build out the fanciest of tech without actually addressing who are the users. I think if I were to summarize this slide with one most important thing or two most important things, one is you need to be talking to your users as much as possible on a daily basis and iterating based on feedback that you're receiving, both data-driven and emotional, empathetic feedback. And number 2, you need to be, essentially you need to be focusing on shipping outcomes and not just shipping software. So you need to take ownership of metrics and be tracking them, because as we get onto shortly, these are things that VCs would like to see as well when you go to pitch. Anything you want to add, Iman, before I go on to the next slide?
No, I think the answer to the answer to this slide, the simple brief to this slide, is don't be so wed to your product, but at the same time iterate it to get it as good as you can. And then when you do, track against those metrics on the right.
Yeah, core foundation. Just you need to be focused on users more than anything else, rather than fixing bugs and scalability. Because if you have a few hundred customers, for instance, or a dozen or whatever, you have a few customers, and they're staying with you, you have no churn or attrition, then that's a sign that, hey, they like the solution. So don't focus on bugs right now. You get to them in a few months. Focus on the users. Ask them what they'd like to see more of, what they'd like to see less of, etc. Okay. And then we get on to fundraising, which is probably the juicy topic, why many people would join these calls. So there are no hard and fast rules. This probably applies not so much to if you're pre-seed or seed, maybe in some cases seed, but you shouldn't worry too much, going back to the last slide, about all of these things, maybe some of them, not all of them if you're pre-seed or seed, because you should be focused more on users. Even Y Combinator, where I've got a friend, me and Iman have a friend right now who's going through the Y Combinator process. The few weeks running up to Y Combinator, all he was focused on, because all they really do, one of the main things they care about is how many users you have, and essentially sign up volume. So before you focus on gathering all these fancy spreadsheets, if you're pre-seed or seed, you don't need to worry about all of these things. Maybe some of them, I'll get onto it. But really, if you're approaching, let's say, a Series A and beyond, and you're hitting that growth stage, then you do really need to have tight control of all of these metrics. But it's good for for all of you to be aware of it, even if you're not at, let's say, a Series A, because some of these you can start tracking now. And the longer you have data for that you've tracked, when you do hopefully hit a Series A or you're going for bigger fund rounds, it'll impress VCs that you've had such preparation, and it would make the fundraise a lot easier for you. So what are these things? Of course, you guys can see it on the screen, but I'll run through them quickly. So your quarterly annual recurring revenue ramp, the beginning annual recurring revenue, new ARR, expansion ARR, churn, so how many customers you've lost, and the ending ARR. Quarterly customer ramp, so you have beginning logos, ending logos, pretty much, full on list of all of the customers coming in, all of those that are leaving, and this leads back to the churns metric as well. Quarterly P&L, historic and forecast, including cash balance, your top customer list, and monthly recurring revenue. Top customer list, I suppose, we were doing venture debt deals and venture deals. One of the main things, or there's a lot of things they focus on in deals, but the reason they ask for top customer lists is because they want to really assess the risks to your business and the customer concentration, similar to geographic concentration and other variables. So if you have, for example, 50% of your revenue coming from just one enterprise, then that's worrying for them. So generally they want to see the risks to your business. So a top customer list and MRR, your customer acquisition cost, so payback, which is essentially the sales and marketing dollars or costs from the P&L relative to the net new ARR added in each period, and that gives you payback. And then the sales funnel, so these are absolutely key. There's all sorts of software you can track these things for sales these days. But essentially, the reason this is important, if you have a freemium product, i.e. a 2-week trial, before it asks them to pay for it, you need to be tracking how many of those trial customers becoming paid customers post the 2-week trial, for example. And so you need to be tracking conversion rates, general cash efficiency, how much you burning to add $1 of net new ARR. So a good example of this is, well, I've written an article on our website about the irrationalities that we're seeing, especially in the D2C space. One of the companies being Casper.com, which is a mattress brand in e-commerce. And they spend $350 roughly for each customer that they acquire, which is extremely inefficient, and they're still loss-making despite their IPO. So you have companies like those guys who really all of their cash is being burned on sales and marketing. More specifically, it's paid traffic, which is an inorganic sort of short-term growth hack. Really, it's not viable long-term. There's no longevity to it. You're not creating a sticky customer base. Whereas some companies, they're more R&D heavy. Some companies, especially if you're, let's say, health tech, you're in genomics or whatever, which requires a lot more R&D rather than doing Facebook and Google ads or YouTube ads, then it makes sense that you have high R&D. And then really your pipeline. I don't like to focus on this one too much because this is a bit wishy-washy. It's similar to how bankers lend or fund M&As based on an EBITDA multiple, or EBITDA's, it's not true bottom line. Similarly, in an early stage startup, a pipeline, you're weighing that you're giving a probability to the chances of that closing. We've seen many cases where founders would say, this is a 90% chance that this deal on my pipeline is going to close, but it actually doesn't close. And then a founder who's a lot more, I wouldn't say a pessimist, but they'd say the chance of this closing is 10%, but it actually closes. So it's very hard to give weights to these things and probability and things like that. But having a high level summary of what you believe and being rational in explanation to VCs when you're fundraising and why you've given these percentages of chances of closing a deal are important, and being upfront and honest and communicating really. So really just a conversion percentage and then the historical win-loss data on the deals in your pipeline. So you need to give reasons. And so tracking the data of the reasons. Is it you lost a deal because of a competitor? You lost a deal because of pricing? You lost a deal because of an issue in your product that you didn't fix in time? So various things. Everything I've just explained is literally just 50% of what they look for. I'd say the other 50%, the final bullet, is probably the most important point out of everything here, which is testimonials and customer references. This carries the most weight because it goes back to when I said, for example, our friend who currently is going through Y Combinator, they mainly care about users at this stage. Even later stages, if you're going for follow-on rounds, the most important thing are your customer references. And these go an extremely long way. So the more you can sort of gather, especially for early stage startups, the analogy for VCs is the dartboard analogy, which is they're throwing 20 darts at a dartboard. 18 of them will fall, 2 of them will stick, which maybe one of them becomes a unicorn, and the gains are so exponential that it makes up for the losses on the other 18 or 19. And so that's essentially, that's how they're looking at the investment. And if you have some proof of work, that makes them sort of more inclined to invest. And I suppose just off the back of that point, finally, is people have very high expectations of VCs. So we've seen a lot of founders where they'll fundraise and they get excited. Oh, I have so-and-so now an investor, and they expect that they're going to be hanging out with this VC regularly, getting advice on hiring, on product, on various functions of the business. But what they quickly come to realize is actually this VC, firstly, some cases runs their own company. Secondly, the VC has made hundreds of investments or dozens. And so their time to you is very limited. There's no real value add. So you should sort of lower your expectations. And that's fine. Some of them are not here to sort of hold your hand. But what I would say, which is why me and Iman set up Rational Fund, is you can, especially in the earlier rounds, you can sort of raise funding from angel investors who will invest even as little as 5K, 10K, 25K. Some of the most prominent investors in the Valley invest tiny tickets at very early stage pre-seed. Why? Well, firstly, the reason it benefits you to get these people in early on is because in many cases, they spend more time with you, and they bring a lot of expertise, especially if they're operators. This is what they love to do. Me and Iman live and breathe this space, as cheesy as that sounds. So we'd be on calls, for example, regularly in an investment. And so similar with other angel investors, we see that among all the angels, whereas a VC will be very busy. They may have dozens in their portfolio to keep track of while running a company. So just be conscious of that as well. But yeah, just back to that point, customer references are crucial. And to some of you, to go on to the tips, this may all seem like a lot, or it may seem a bit daunting. Don't worry. It's not, you can't do a million things. You're good at 1 or 2 things, double down on those. It's very common these days to hire they call it quote unquote CFO as a service, which is a subscription. You pay, let's say, $1,000 a month or $500 a month to an individual. And there are quite a few of these online. If you guys need intros to any, we're happy to give intros, or we're happy to help you, guide you in how to find them online. But these are typically ex-investment banking people or consulting people. In some cases, some of them still work in these companies, but on the side, they charge a subscription fee to essentially be you could call it a CFO on the side and handle all of these things. These are people like Iman for many years who have lived and breathed Excel and PowerPoint day and night. And so they can whip together the fanciest of dashboards and track all of these metrics and more, which will really impress VCs when you go for the fundraise. Really the best way, I suppose, you could ask for intros in your network. And if you don't want to pay them, if it's early on, you're trying to stay lean and bootstrap, you don't want to pay them a monthly fee. What you can do is give them a tiny slice of equity. I've seen a lot of people, me and Iman see this a lot. You'd be surprised how many people work for, let's say, McKinsey, Bain, BCG, Goldman, or any of the top tier consultants or IBDs. And they don't have any of this information on their LinkedIn, but on the side, they are involved in, let's say, a startup or 2, or in some cases, multiple. And what they do is, in their very limited spare time, in the evenings or weekends, they'll be working on your project. And in return, you give them a very tiny slice of equity, so they have a bit of skin in the game. And as the saying says here, what gets measured gets managed. So don't ignore these. If you're pre-seed, you can't track all of these, but as soon as you can start tracking some of them or get some help, please do, because it'll make the fundraise process a lot easier for you as things progress. Anything to add, Iman?
No, that all sounds pretty comprehensive. All I would add is With a CFO as a service, it's always best to go through someone or get a warm intro from someone. I wouldn't cold outreach people because you can't be certain of them and you can't audit them in every case.
Agreed. Okay, I suppose we've essentially reached the end, which is we leave the last 15, 20 minutes for everyone else to get a chance to speak.